How's it going, everybody? It's Stas here. So in this video, we're going to be going over everything you need to know about how to sell covered calls. We're going to talk about how to open a position, how to close a position, the risks of covered calls, what the heck is a covered call. We're going to talk about everything in this video. So sit back, relax, smash that like button if you find value, and let's get right into the video. So a lot of people know what buying calls are, but not many people know what selling calls are, right? And you have to understand there's two sides to every transaction. There's a buyer and there's a seller, right? So when you're buying calls, you are buying the contract. You're buying the call option contract, and you expect that stock to go up, right? And if it goes up a certain amount past the strike price, you're going to make money on that position, right? And if it doesn't go up, well, you're going to lose money, possibly your entire position. So buying calls is you're buying the option, right? The option contract, and you think it's going to go up in price. And like I said, there's two sides to every transaction. There's a buyer and there's a seller. So selling calls is, well, you're pretty much just selling calls, and there's a lot that goes into it. It's not that simple, and that is what we're going to be talking about in today's video. So when you buy call options, right, you're paying a premium. So when you sell call options, you are receiving the premium, and this could be anywhere from 10 cents times 100 because there's 100 shares per contract, right? It could be 50 cents. It could be $10 times 100, you could be getting, $1,000, whatever. It depends on what stocks you're dealing with. So when you're selling calls, you are receiving the premium right off the bat. And the first thing you need to know about selling covered calls is you have to own the underlying stock that you're selling calls on. You have to own at least 100 shares of this stock. At least. Let's say you own 50 shares, 25 shares. You cannot sell covered calls because you're not covered. That is why they're called covered calls, because you own the shares. So let's say you own 100 shares of the underlying stock. You are able to sell covered calls and create income pretty much from thin air, right, by selling these calls and then collecting the premium. And in my opinion, this is better than dividends. I mean, it's arguable. I don't know. I mean, it depends who you're talking to, but in my personal opinion, collecting income from covered calls is better than dividends, and this is a great way to make money by just simply holding on to your stock and waiting for it to do its thing, right? Let's say you own 100 shares of Disney and you're holding on tight. The stock isn't doing much. It's kind of flat. It's consolidating. Maybe it's moving up slowly, very, very slowly. You can sell covered calls against your Disney shares to create income and really just make money while you're just holding on to your shares. It is literally that simple. Well, there's a little bit more to it than that, which we're going to talk about in this video. So like I said, the second you sell a covered call, which we will hop into Robinhood in a couple of minutes here, so stick along and we'll go over how to actually do this. The second you sell a covered call, this money is credited straight to your account. So your cash balance will increase, your buying power will increase. You literally make that money the second you sell a covered call, right? And the way you open a position, this is very important because, again, a lot of people know how to buy a call option, but they don't know how to sell a call option. So the way you do this is, A, you have to own at least 100 shares of the stock, like we already mentioned, and B, you have to go to sell call and go to sell to open. So we might as well just hop right into Robinhood right now, and I'll show you guys exactly how to do this. I was going to do it later in the video, but it's better for a visual to do it right now, so let's hop right into it. Alrighty guys, so here we are on Robinhood, and full disclosure, I personally don't use Robinhood, so I want to get that that out there right off the bat. I personally use Fidelity, but Fidelity's platform is a bit more complicated, so I'm going to do the example here on Robinhood for all you guys out there that are beginners, and most of you out there probably use Robinhood yourself, so I want to show you all how to sell covered calls on Robinhood. So let's use Snapchat for this example. So Snapchat is currently trading at $75 per share. And again, in order to sell covered calls on Snapchat, you have to have 100 shares. So do 100 times 75. That's $7,500. So you have to have a minimum of $7,500 worth of Snapchat stock to even consider doing this strategy. And what you're going to do from here is, again, $7,500 of Snapchat. You have 100 shares. You're ready to go. Now you're going to go to Trade Snap Options. And instead of doing buy call, which is the default here, because they want you to buy calls. And first and foremost, let me say this right now. Selling covered calls is way less risk than buying them. In this case, you're pretty much acting as the casino, right? You're the casino. You're selling these calls to people out there gambling on the short-term price, and you're just collecting the premium. And the win rate on selling covered calls is very high. It's like I said, it's a lower risk strategy, and depending on how you do it, it is a win-win strategy. So what you're going to do here is sell, call, and you're going to pick whatever expiration you want, whether it's September 10th, 4 days away from me filming this video, October 8th, whatever you want to do, right? And let's say your average cost, and this goes into determining the strike price, which is so important. Let's say your average cost on Snapchat is $75 per share, right? You are not going to want to pick a strike price under $75 per share, because one of the downfalls of covered calls is, let's say the call option expires in the money, your shares are going to be called away from your account. You're going to have to give up your 100 shares, but you do keep the premium. So in this case, if you pick a strike price under your average cost, you're going to lose your shares and take a loss on your position, if that makes any sense. So you're going to want to pick a strike price above 75. So let's say you pick an $80 strike price for Snapchat. What is going to happen is you sell the call, you are going to be credited $2.19 in premium times 100, which is $219. So if you were to just sell this call right now, click continue, right? You are going to make, take a look at this, expected profit and loss. Let me make sure that's showing. You guys can see it if I shrink my face a little bit more. Expected profit and loss, you are going to receive right off the bat $219 for simply selling this call. And the idea is, when you're selling covered calls, you want the call to expire out of the money, right? You want it to expire worthless, because in this scenario, you keep your shares and the premium, right? But let's talk a little bit about what could happen if the shares expire in the money. If you sell an $80 call, and this one, for this example, expires October 8th, let's say, for example, the stock is well over $80 before or on October 8th, you are going to have to give up your shares at $80 per share. And going back to what I said earlier, this is why it's extremely important when you're selling calls to pick a strike price above your average cost. So important, because in this example, with your average cost being $75 per share, you are going to have to give up your shares at $80, which means you are going to make a $5 spread on your position when you give up your shares. So 80 minus 75 is $5 per share profit times 100. You're going to make $500 profit on the actual shares, right? And you keep the premium on top of that, which is $219. This is why, if you do it correctly, you pick a strike price above your average cost. Selling covered calls is a win-win strategy, because you keep the premium for income, as income, shall I say, and you make money on the shares if they do go up and expire in the money, which, mind you, most call options, when you're buying them, they don't expire in the money, which is why when you're selling call options, you are the winner in that scenario for the most part, right? Because selling options is the winning strategy, statistically speaking. So in that example, you would make like I said, $80 minus 75, that's $5 per share profit on the actual shares, and you'll make that $219 profit from the premium when you initially sold the covered calls. And I'm not actually going to execute this trade because I don't own 100 shares of Snapchat in this account. Again, I don't do any trading on Robinhood, but if I were to do it, I would click review order, and then I would do, well, here you go. It says not enough shares. You don't have enough shares of Snap for collateral needed to sell Snap, $80 call. So I can't even do it. But if I were to do it, I would click execute. I'd get, credited that premium. And then I would monitor my position from there, which we'll talk more about here in a second. And another thing worth mentioning, which I almost forgot to talk about, when you sell a call, it's going to show up as -1 next to whatever call you sell. And when you buy a call, it's going to show up as +1. And when you put your order in, when you're selling a call, you're going to want to do sell to open because you're selling a covered call to open a position. That is very important. Remember that. Sell to open. And when you're closing a covered call, you're going to want to buy back your call and do a buy to close order. This way it negates what you originally did, and that is pretty much how you close it. So there's many ways to close. Well, I don't want to go into the nitty gritty here. This is more of a basic video, but you can buy to close in order to close a position, or you can let it expire. If you let your covered calls, expire, or the options expire, literally nothing's going to happen. Your shares won't get called away. That is, if they expired out of the money, which most options do. Your shares will remain in your brokerage account. You'll keep the premium and you'll be good to go. And let's say the stock you have is running up very aggressively and you want to get out of the covered call in order to keep your shares. You can buy to close, like I said, and take a loss, because let's say the premium is skyrocketing, the shares are moving up aggressively, and the premium is a lot higher than what you originally paid or got credited, rather, right? You're going to take a loss on that spread, if that makes any sense. But this way, if you want to keep the shares, this is an option for you. Again, you can buy to close, and in this case, the premium you pay is higher than what you initially received when you wrote the call, hence the loss. But hopefully, now that the stock is skyrocketing and you want to keep your shares, right, it will offset that loss you took on the premium, if that makes any sense. So what are some of the downfalls of covered calls, right? We're talking a lot about how it's a win-win strategy. You could make money on the upside of the stock up until the strike price, and you keep the premium. What are the downfalls rather? So number one, your gains are capped. That is a very big downfall of this strategy, meaning you can only make money up until the strike price, right? So let's say you sell covered calls, the stock, in this example, Snapchat, goes well above $80 per share. It goes to 90, 100 before expiration. You're going to have to give up your shares for $80, and you're going to miss out on all that additional upside from $80 to $90 to $100, wherever it could go. So in that case, it might have been better to not sell the covered call and just keep your shares and really ride up the price and get maximum price appreciation from the shares, if that makes any sense. So that's pretty much the biggest downfall, the fact that your gains on the stock are capped, and you could only make money up until the strike price that you personally selected. So let's say, for example, you buy a stock for $10, you sell a $15 covered call, collecting a $1 premium, and the stock soars to $20 on or before expiration, you could only earn capital gains up until the $15 mark. So you're not going to make money up until $20 per share. You're going to have to give up your stock at $15 and you only make $5 per share profit. And you get to keep the $1 premium you originally collected for selling the covered call. And I also want to go over when to not sell covered calls because, like I said, it's not always the best option here. And if you're extremely bullish on a stock, you think it's going to go to the moon, let's say Snapchat, I think it's going to go from $75 to $150. Maybe the best thing to do in this case would be not to sell covered calls and to simply hold onto the stock so you don't miss out on the breakout, the huge upside. So that's pretty much it, man. We went over a lot in this video. I'll probably make a lot more videos on covered calls. Maybe I'll make a video using Fidelity one time, showing you all how to do it there. But overall, what it comes down to is collecting income, collecting that premium, and being the casino, right? That is what it comes down to. And picking the right strike price is so important as well, like we discussed many times in this video, so you can make money on your actual position, right? And another time not to sell covered calls would be if you're down a lot on a position. It's probably not the best strategy in that case. You want to be pretty much break even or up on your position and, then sell covered calls, collect that premium. And another thing worth mentioning is, guys, don't sell covered calls on stocks you're not willing to give up, because when the time comes around at expiration, and let's say it's looking like you are going to have to give up your stock because the options are in the money, you're going to have to give up your stock. So don't be married to a stock that you're selling covered calls on, and be willing to give it up. Be willing to cough up that stock at expiration if the options do expire in the money. So that's pretty much it, guys. I hope you all enjoyed it. If you did, hit that like button, drop me a comment, let me know your thoughts, and subscribe to the channel if you guys want more options content, daily stock market content. This is the best channel for you. And check out my Patreon as well if you want all my real-time buys, sells, call outs, options moves I'm making, long-term investments I'm making, everything I'm posting on Patreon. Check it out. Plus, I make a morning update video every day for my top tier patrons on there. That is linked down below, or you guys can go to StockSurfest.com/Patreon. I'll catch you guys there. Make sure to grab your free money down below from M1 Finance, from Webull. All of those are linked in the description box. I'll catch you all in the next video. Thanks for watching. Again, as always, keep crushing the markets. Stay safe out there.